the way that we've calculated this is you need something like a recession and a half on average. If you take the average recessions for 50 years, you need like a recession and a half just to get the labor supply demand and the consumption supply demand back to something that's almost a previous cyclical peak. Like it's almost in line with the peak of the dot-com cycle if we had a recession and a half from here. So that is how hot these economies actually are. When you think about this world that we've been building for 10,000 years of more and more integration as a society, the last 50 years was this extreme blow off of that. And it's left us with these huge interconnected dependencies across different countries and this very specialized sort of world of production that we live in. And so even if companies are now, and like to your original point, this is a time of extreme uncertainty for a number of different reasons, right? So companies know they have these spending priorities that, all right, we got to go and build a new supply chain for X in somewhere that's sort of like a friendly nation or a home nation. And that actually doesn't get us any incremental IRR. It's not like we're doing it for price sensitivity reasons or optimization reasons. We're doing it simply because we cannot be in a position where we can't stock shelves anymore or have availability of critical supplies. And so it's like there's this whole set of corporate spending priorities that are both responding to the extreme amount of demand that we have and the limits that that's created, but also from a more structural standpoint are saying, look, next 5 or 10 years, we can't have total reliance on China or whatever in this world of, just shifting order and shifting security of those previous dependencies. So I doubt that this is something that, you're going to hear in earnings calls right now, like, oh, we're going to go and spend X billions on, retooling our supply chain in the next couple of years. But it's something that's a structural spending initiative that will have to happen over the next 3 to 5 years. And it's not just companies, it's governments who have to do it too, like to your things that we've talked about in the past on CHIPS Act and semi-supply and the role that government is having in ensuring, obviously energy is a very topical point in ensuring the security of supply across the world. And so there's a whole bunch of different sort of CapEx and spending initiatives that have to happen at all sorts of different player levels to prioritize a world where maybe it's not fully integrated anymore. And it's just that marginal delta that I think is starting at the moment.
I would like to get back to the sort of global ramifications of a potential CapEx pickup over the coming decade as a consequence of this trend. But before we get to that, let's take a deep dive into the technology sector. You mentioned tech initially in your response to my first question, and I would like to get your take on whether the tech sector in the US is actually moving towards bringing the supply chain back from China to, shores closer to the US. Apple, for example, announced that they wanted to move parts of their supply chain from China to other regions. Is it actually a trend, or is it mostly hot air at this stage?
I think mostly what you've seen as an actual trend is obviously there was a huge exodus of companies out of Russia. Now, mostly Russia was a demand center for a lot of companies and suppliers. You've seen at the same time a little bit more deliberate movement of operations and sort of tech reliances out of China, either because they're sort of seen as like the next potential issue where we know there's obviously a bilateral set of tensions between the U.S. and China, and the U.S., at least, with respect to semiconductors and things like that, is forcing people to stop selling into that market or to adhere to certain rules and restrictions and so on that never used to exist. And obviously this all started back with Trump, but has continued under Biden and is generally makes sense given the evolution of where we are in the world, that you have this upstart rival, that the U.S. is sort of protecting its incumbency. You have this rival that has a whole different set of values. And at the end of the day, those two powers have goals that are just not aligned with each other anymore. So even if, you come out of the G20 last week and everyone's talking and, it's good face-to-face meeting and it's a plus that the G20 still exists as an entity and can draft a communique and all this stuff. But at the end of the day, those frictions between the two main sort of power centers of the world are not that tractable, and they're attracting different allies to their respective causes. And you probably end up with a bit of a non-aligned movement in the middle like we had during the Cold War. So the problem is, from a tech perspective, where do you actually move your supply to? Because a lot of this stuff is very long lead time, right? So you're thinking about building a new advanced node fab, where are you going to do that? Can you do it in India? Can you do iPhone assembly in India? I mean, they're trying, right? And so there is definitely a marginal move of incremental investment spend out of that area, but there's not, something massive and wholesale, like, okay, we're just going to scrap, in the way that Russia was massive and wholesale. It was like, we'll scrap that. We won't do business there anymore. I think people are sort of dealing with the China issue with a little bit more, incrementalism, I would say. But the thing about tech is, I think the bigger point is not so much that, like, globalization and thinking about supply chains and security of supply, it's going to affect all sorts of industries, not just tech in particular, because we've come out of 15 years of no investment across pretty much any industry, right? And even like looking at semis, it was the same. It was like, okay, from 2015 onwards, revenue surged for advanced semis. The whole total annual size of that industry continued to go higher. And yet there was no incremental change in CapEx from 2015 through to 2022. And so then you I should say 2021, because then there was a big CapEx response. But you're growing into what was like a very limited availability of supply. And that same thing is true with respect to tech as it is with respect to energy and basic materials and, industrial or manufacturing capacity, housing. There was literally no investment in anything physical for most of the last cycle. And so you're just hitting these supply issues at the exact point in time when people need to figure out, okay, well, we need to actually expand capacity. Where is the right place to do that? So these two things are intersecting at the same time, which means that the potential for that shift of CapEx to new sort of destinations and recipients is probably bigger than at a point when, let's say, everything was already oversupplied. If everything was already oversupplied, you're sort of going to like get the longest useful life out of those things as you can, and maybe walk a little bit of a balance between using that stuff, using the capacity you've already spent money on, but also trying to have some sort of tail risk or hedge capacity somewhere else. And now it just seems like, look, everybody hasn't invested for a long time. They got to do it anyway. They're going to try to do it somewhere friendly or somewhere where you at least are taking into account as a factor how secure that place is.
In hindsight, it is now very clear that we struggled with a lack of supply of various goods, but also technological goods throughout the pandemic. But it seems as if the tide is turning a bit when we look at that exact question today. So if we look at the semi sector as an example, it seems as if inventories are now growing as a consequence of the post-pandemic economic trends. So what do you make of that supply-demand imbalance at the current juncture?
Yeah, that's 100% right. So here's the issue. This was never a supply issue. It was never like, if you think about, like, there's a very easy way to tell whether prices are going up because of a supply shock or prices are going up because of a demand shock. And the simple way to tell is, did the volumes that got transacted go up or go down? We basically got to a point where we were spending, like, if I'm talking about the US, we were spending in real consumption terms about, if 100 was Jan 2020, we got to about 118. We're still at about 117. And so there's not really been a big softening in real consumption. But what has happened is, initially there was this huge disproportionate demand surge for tech and handsets and PCs and everything like that you just physically needed during the pandemic, as well as other consumer goods. And those things push the availability of existing supply to the limits of what could be supplied, including from imported supply from abroad. And so you had this surge in imports and this big trade deficit and all these things associated with trying to plug a fundamentally huge excess demand gap. And now what you're seeing is just a violent shift out of goods and tech to services and broader parts of the economy, which are much larger parts of overall spending. So when I look at things like the fact that, inbound port volumes are down, or trucking throughput is down, or goods demand is down, or tech hardware prices are down. If you look at the anatomy of the inflation prints for the last couple of months, pretty much of the very few components that are falling, most of them are tech related or consumer goods related, right? And what you're seeing instead is this surge in mix shift towards where people are spending. So I think fundamentally, if you look at things like supply indicators that yes, of course they got stretched because demand was so extreme, but that was not really the core cause of why inflation was high. The core cause of why inflation was high was because people were given so much money to spend on things without having to actually produce things. And so you just exhausted the available supply. So yeah, the supply chain issues are coming back, but the issue is we still have this huge amount of excess demand, which is now being fed by this organic, high income, high wage growth sort of, purchasing power. So we got to choke that off before we can fully bring inflation back to something more reasonable.
Hey there, revolutionaries. To join a community sharing insights like you just watched, head over to realvision.com. There you will get unbiased insights and exclusive access to the very best, brightest, and biggest names in finance. Be a part of our community of lifelong learners. See you there.